Welcome back. Let's get into that market picture, and we start off in the Far East, where Asian markets retreated this morning, and the dollar held gains after a blockbuster U.S. jobs report dashed hopes that the Federal Reserve would slash interest rates this month. Labor Department data showed that despite recent disappointing indicators, the world's top economy continues to show resilience as it created far more posts than expected in the month of June. Now, the news took traders by surprise and sent all three main indices on Wall Street falling from record highs, while the dollar bounced against its main peers. Tokyo's Nikkei fell off 1%, while the Hang Seng lost 1.5% there to sit at 28,331 points. The biggest loser, however, was that Shanghai Composite, now sitting firmly below that 3,000 point mark, dropping 2.6% by the close of trade. Let's head on over to the United States then, where last night's Wall Street stocks retreated on worries over slowing global growth and diminishing hopes for an aggressive Federal Reserve interest rate cut. U.S. markets continued, however, to pull back after Friday's strong June's jobs report left investors betting that the Fed would not necessarily cut interest rates by less than previously thought. About 20 minutes into trading, the Dow Jones Industrial was down as well, and by the close of trading, it was 0.6% lower. The broad-based S&P 500 also shed a similar mark, while the tech-rich Nasdaq Composite Index was 1% weaker as well, pulled back by Apple's decline. U.S. stocks have pulled back since all three indices closed at record levels last week Wednesday, following that ceasefire on new tariff actions in the U.S. trade war amid hopes for easier monetary policy. Let's check in on the rest of the market world and what's happening necessarily today. We begin out in Europe, of course, as well. Then that market seemingly also in the red as things begin to turn negative. It does seem that the Fed interest rate cut agenda is still on the table right now, and that is exactly what market commentators are perhaps looking at and saying to themselves, where exactly do we head to from here? Doesn't look good at this point in time, so all giving a sense of negativity across that European market. On the local front, we saw the JSE go up 0.25% yesterday despite the negativity of the rest of the world, but unfortunately today it has begun to follow exactly what the globe has done. 56,978 points at present. That's down below that key 57,000 point mark as the JSE falters a touch today. Industrials, the 10 cent was down earlier today in Hong Kong, so that means the likes of Naspers are not doing well. It's day two for them with regards to declines, and that market then going down. Let's check in as well on the resource counters. They have fared quite difficultly as well, up one day, down the next today, however, in the red in that territory, however, not doing as well as one would have hoped. We did see some positivity come through from those gold counters yesterday as they ran up around 3% of gains at some stage, but that's all filtered through today and sadly going below that key 2,000 point mark for the gold shares. In your resources themselves, well, the yellow metal seems to have faltered and gone below that $1,400 a fine ounce mark, with platinum still only just above that $800. And of course, the big concerns around demand is one of the questions at play then for that oil price sitting below that $65 a barrel mark, but still haven't gone up from where it was last night at around $63 a barrel. And a quick look at the currencies then as well. Of course, we had hoped that the rand would stay below that key 14 rand level. It isn't and continues to weaken now at 14.22 against that US dollar. A key level then is perhaps that 14.25 as it looks to search for another barrier where it doesn't need to pass through. 15.92 for a euro, and staying below that 16 rand mark is quite key. And then the British pound at 17 rand and 71 cents. Live from the Johannesburg Stock Exchange, Martin Harris from IG South Africa joins us as we get into that market picture and discuss the details just a little bit more. Martin, thank you so much for the time. A big fall for the JSE today, 1 2/10% weaker, following through from yesterday, which is, for me anyway, a slightly surprising move of 0.25% uptick. Is the market now finally correcting in some sense, sort of moving in tandem with the rest of the world?
Yeah, so I think Arabile, basically what we're seeing is after the Asian markets largely mirrored United States markets yesterday, so US fell, Asia fell, and now we're seeing South Africa and Europe fall. This is broadly on the back of the strength of the US dollar, so we've got a risk-off sentiment, people moving money out of equities and into something stable like the US dollar.
Yeah. In searching for that US dollar, however, in terms of stability, you get the sense, however, that because the Fed may not necessarily hike as rapidly as one would have thought, that markets are beginning to shift and find another safe haven. Where is that?
Exactly. So we were expecting multiple hikes this year and next year, at least 2 this year and 2 next year. And what we've, multiple cuts this year and next year. And now what we're seeing with the strong jobs reports from the United States, that what we thought would be a fairly dovish Fed is now possibly off of the table. And that's why we're seeing this really strong US dollar, because we're not expecting the markets to be, the rates to be cut. And so the markets are now peeling off a bit because they were expecting a rate cut. And that's why as soon as the US engages in a bit of easing through rate cuts, the stock market gains tremendously. People are able to borrow at really low rates and get a higher return in the stock market. That being said, now because that US dollar is getting so strong, there's no need to be in risky emerging markets. Rather just put your money in the dollar and avoid the risk.
Yeah, and in avoiding the risk, that means South Africa then gets to suffer, and that's perhaps why you're getting a sense of weakness in the local currency.
Exactly. I mean, so South Africa serves as a proxy basically for emerging markets. The rand is a highly liquid, tradable currency, and so you get a lot of trading in the rand as a way of trying to mitigate exposure to emerging markets. So people go short on the rand and try, and if you've got a exposure to sub-Saharan Africa or Africa in general, sometimes the Middle East, you can use the rand to levered trade on the rand to avoid exposure, try and hedge out some of your exposure. Yeah. So we see a huge amount of trading, and unfortunately it's the South African consumer who pays for it at the end of the day. That the rand now quite weak, so we'll see inflation pushing through into the South African economy because of the imported goods in US dollars.
Yeah. You expect a rate cut from South Africa, however, considering the perhaps the easing of temperament for a rate cut in the US?
Right, so where this puts us, I mean, now we're not too sure if what the situation is in the United States, if they are going to cut rates as aggressively as expected. If they're not cutting rates, South African Reserve Bank are now in a difficult situation because they're aiming to protect the value of the rand. With the rate cuts up until sort of last week that were expected in the United States, inflation targets in South Africa were looking doable. We saw that the 5-year inflation target, if you look at the difference in spread between the inflation-linked South African bonds and the non-inflation bonds, just the vanilla bonds, that we're expecting about 5.4% of inflation over the next 5 years. This is just within the bounds of what the Reserve Bank are looking to target. If we were to get inflation above that, now if the US market, if the US Fed isn't going to cut rates, we would probably see our inflation increase, and then the South African Reserve Bank step in and increase rates to try and keep inflation within target. Yeah. What we possibly might see though is, I mean, we were hoping for the South African Reserve Bank to cut rates, ease the local consumer, but we might not see that now. If the US don't cut, we won't be cutting. But if the US cut, then South African Reserve Bank might do some cutting.
Clear and concise. Thank you so much for that, Martin Harris. Appreciate your time there. Martin Harris is from IG South Africa, joining us live from the Johannesburg Stock Exchange. We'll continue to give you more news right after this short break.